Hello, everyone. Mike Arnold here, co-founder of Path Trading Partners, along with, hopefully to be on soon, Bob Iacino. He might be running a little late today. He's recording a podcast right now. So, that's where we sit. Little reversal today. Little reversal. Got some momentum bars after we hit some key levels. So we'll see if we get any follow through tomorrow going into the end of the week with consumer sentiment out tomorrow morning. Remember, it's the preliminary numbers, but the market will react to it. Hello, Connor. Hello, Options 22. Hello, Davey. Hello, Daniel, Patrick, Lauren. Cute little pullback. It's a cute little pullback. Boy, how people, and I'm not talking about you, George, but I mean, you have this little minor pullback, and it's like, is the market crashing after this up move? It's absolutely absurd. People are just, I don't even know what to make anymore. People got to tune into this channel. Anissa, good evening. Hey, King. Glad to have you here. Oh, by the way, we're getting more and more new people. We're getting closer to 5,000 subscribers from this silly little technical analysis channel. And by the way, if you are new here, please do consider subscribing, ringing that bell, and hitting that like button. And I appreciate all the longer-term subscribers that come back and leave some comments, because we're edging ever so slowly towards 5. A warm porridge today. Remembering the 3 bear porridge analogy markets. Hey, Coco. Anybody see the high grade credit and the little? I mean, the market sold off once we started getting the notes got absolutely slammed. Notes got slammed. High grade credit got slammed too. Final stuff after hitting a key level. We also hit the full double target on Apple. Wow. ARC even hit the stop reduction target on the double before reversing. Well, you listen to me. You'd think I was bullish. Oh boy, hey, Dr. Michael. So remember tomorrow morning, consumer sentiment out at 9 a.m. So 30 minutes after the open. So we get to see that open and then consumer sentiment. I'm expecting it to beat the forecast, easily beat previous, and beat the forecast because of summertime and because of gas prices. Oh, Goldman Sachs tanked the market. Guys, we've been overbought. We finally got some momentum. It actually was more related to the horrific, from my perspective, the horrific bond auctions. They actually were pretty horrific. So that's tomorrow. Then you got Baker Hughes oil rig count. There we go. That finally refreshed. Nice little reversal in Amazon, Tesla getting a fair amount of pressure under. Well, you still got some substantial selling going on. Still looks like it could be some also Ellison selling, but you also have substantial pressure from full self-driving coming under more of a microscope. So we'll see if that can finally put an end to some of this Tesla rally. Megacaps pulling back. Apple again after hitting the full double target and reversing crude and oil stuff up again. First target essentially hit. Remember, I brought in that target, the stop reduction area, just a bit in front of that 95 area, and I explained why. Healthcare still short-term rotation out of it. So that's where we sit with that. I actually didn't refresh this. Let's just see where this sits, if it's going to pop up. Let's see. I mean, I think everything's gearing really towards that 50 basis point still. And that's where we sit. And alpha, where's my flip point? 41.28. 41.28 will peak at that also. People realize inflation is still terrible and not going anywhere. What do you mean? I thought they said it was 0 yesterday. Oh, that was month over month. Oh, sorry, I was mistaken. Elon said without full self-driving, Tesla is worth nothing. Well, at least somebody realizes it. Did anybody check on Rivian's earnings? I did not get a chance. That's the only thing I was really going to peek in after the hours. I mean, we're really winding down earnings season. If there's anything anybody wanted me to look at, I will. It's going to be a shorter little session, probably. Tomorrow morning, again, nothing that I'm really interested in or that's going to be supermarket moving. Just doing that for the point of completeness. Okay. All right. That's not. I mean, yeah, they said even what they were really. They said 130, I think. Goldman Sachs. They said gas back over 5, but that didn't really tank. That didn't tank the market. I mean, the market's still very overbought. Hit overbought level on the RSI again. Would not be surprised to see a pullback, although we can see tomorrow if we're still in juice mode, got a little profit taking. Here's what I was talking about with, let's take a look at a couple other things. HYG, high grade credit. This is a good way to just check in on high grade credit. So we had the double, hit the targets. You also got the close. I'm just recapping some stuff because I don't pull this up all the time in the live stream. But you got the close also above after it hit the double targets above 62.5. Actually gave plenty of opportunities to get in for that 87.5 to 100% target, hit that 87.5, and then the pretty big rollover move at this point. Let's just take a look at a couple of things. ARC hitting that first target and pulling back the stops. I mean, if you're trying to stay in this longer term, the stop's way down there, but I wouldn't even have a stop if you're even trying to stay in the shorter term above 46.70 because you have the 50 right there. But that hit the stop reduction. I got people telling me that wasn't even going to hit the stop reduction, and you don't know. You got to trade them. You got to trade the probabilities. And Apple, you see coming up, hitting that target, and then a minor reversal. So that is all done. There's a couple things that keying off of there. Here's your notes. Again, nowhere near a stop on the inverse head and shoulders. Now I'm watching for the more substantial pullback follow through to see if we can get back to this 50% level from this up move. But the next breakdown level for me is now this 118.30. Sitting in there. Remember, we had weekly cycle still rolling over, so we could see more choppy to pullback move before we get going with that. Crude, by the way, we'll get to the indices in a bit. Hitting, remember I said it got to 95.50.05. The stop reduction was 95.15. Mine was 94.95. I hate when it's just on the other side of this. So that's already hit stop reduction. And again, remember, slightly lower probability against the daily rotation zone. I'm actually expecting more of a move towards the weekly rotation zone with this because of weekly cycles, and that would take it to the full double, but at least it's hit the stop reduction area. For the stop reduction targets, 90.03. And again, when I see a number like that, I'd make it 89.95. Just because you can get a little noise just around that level. But that would be the key level to invalidate the pattern at this point. Still waiting to see if Bob can jump out. Where's Papa Bob? Papa Bob's recording a podcast right now that's probably running over. Hey, John. Yeah, I know the China economy is in big trouble, I think also. Rich. Hey, Sashi. That's going to be interesting. No, John, they only keep going on the days that TomTom shows up. Know that. Okay? We actually had a red NASDAQ close. The S&P was still technically higher than yesterday's close and higher than the open today. S&P's still up. The only one that closed red was NASDAQ. Hey, look. Look at this. Look at this. Look at this. Pause everything. Hold on. Pause everything. We've got the magic Bob button. There he is. There he is. Look at that
I made
blue
it.
shirt. He made it.
I made it.
Bob, no,
What's up,
I'm turning
guys?
it over to you. I'm done, Bob.
That's it.
I'm
Anybody got
done.
any questions?
Well, why don't you talk about the PPI? Why don't you talk about anything else? We got consumer sentiment preliminary numbers. We have a potential, finally, a potential short-term top happening. What potential short term?
Look, PPI validated CPI. It's not a surprise. PPI would likely be weaker than CPI in most cases. In the past, we had actually stopped looking at PPI years ago because over the last 10 years or so, when we had no inflation, PPI, regardless of whether it was up or down, did not feed through to CPI. So all we looked at was were companies able to make their net results or net profit with PPI higher, and they were. So it became a non-event. Now you can look at PPI as sort of this was the July PPI, so it's already fed through. It seems sort of theater of the obvious after the fact because we had crude oil go down, we had copper go down, we had ags go down, we had all kinds of inputs go down except for labor. Labor is likely to be reflected in the next PPI. But the interesting thing is, labor is one of the largest things that affects price, but it is not a large component of PPI. So again, PPI becomes more of a confirming mechanism rather than something that's any sort of surprise. The Michigan sentiment will matter a lot tomorrow. Consumer confidence has been very predictive of recessions, as much so as, I should say, economic downturns, as much so as the 2s10s yield curve inversion has. We just finished a podcast with Dave Cullum, who's a professor of organic chemistry at Cornell. And first of all, if you're offended by cussing, Dave cusses like every other word. So you probably shouldn't watch this podcast. But he went through a lot of different scenarios as to why recession, the word recession doesn't matter. He talked about his two black swans. Um, essentially, the PPI number was no surprise. And you saw in the reaction by stocks and yields, which ended up slightly higher, right? That it doesn't really matter that much, the PPI number. The PPI number would matter more had it beaten dramatically to the upside, than it acted as basically a confirmation to the CPI number that we already got.
Uh, Daniel has those PPI a derivative.
I'm not sure what you mean by that. I mean, it's its own set of data, but it essentially confirms that CPI wasn't a fluke for this particular reading. You know, they're both July. We used to get PPI before CPI. The BLS changed that. And I think they changed it because it kind of stopped affecting CPI, just at a bare minimum reading level. The levels they just weren't correlated like they had been in the past. So I'm not really sure what you mean by that.
Let's see. John asks. Well, welcome, John. Hold on. Oh, Tom needs to tell us when he won't be here so we can buy puts.
Well,
uh,
TomTom doesn't listen. TomTom doesn't come in after the fact, so you won't be able to buy the puts. He looks to see if the market was up, and then he comes in and says it just goes up. And on days that it's down, he's not here.
well, yesterday you weren't here yesterday afternoon where he says the S&P will never, or the spiders will never again close below 400.
Where are they today?
Uh, where does I mean we need a bigger pullback than today, but they're
I didn't
above
see that.
400. But that was like a 400 is right here,
Yeah,
but never again.
never again. Yeah, that's idiotic.
Uh, that's not that big a drop. Even if we even have another, even if you don't go to new lows, that's not that big a drop. But oh well, we're done with that. Why? John wants to know why is energy going up?
All right, so it's interesting. Both OPEC and the IEA released reports today. Well, overnight. The IEA is the International Energy Agency in France, and OPEC is OPEC. Now, OPEC's reports always tend to lean toward higher prices. But in this particular case, OPEC shrunk their demand estimates. They say demand is falling. The IEA said demand is increasing. Now, if you think about it from, okay, why would OPEC say that if they tend to lean toward higher prices in crude oil? Well, because they're going to use their demand forecast. This is my theory, to again start cutting production or not meet the production goals that they currently have. The IEA is more of their report is considered a little bit more legitimate because they don't have a dog in the fight or a horse in the race or a kid in the cradle. I don't know how these cliches all work, but essentially they don't have a dog in the fight. So their report is considered to be more independent, and they upped their demand forecast going forward. So that's what pushed crude oil higher. Where did natural gas, am I saying that right? Natural gas. I am tongue tied after an hour and 15-minute podcast. Nat gas was higher when I did my commentary on it. I believe it closed higher. Oh yeah, it closed much higher.
Yeah, and it also triggered. I mean, this triggered before on the shorter term basis, and then it hit the first stop reduction on this double.
Yeah, that's a big jump. The EIA, the nat gas, the EIA came in lower. The inventories came in lower than expected. The supplies or the deficit increased, and we're actually getting pretty steady weather demand, leaning toward the high side. So that's my thought on energy.
Well, George is exhausted. More black swans. We've had a black swan every quarter since 2020.
Well, I'll give you guys a preview, and Dave explains it a little bit more. But his two black swans are number one, the Fed continues to fight inflation until it gets to 2%. He said, I don't think the market's ready for that. I mean, that would essentially put the Fed funds rate somewhere around 5.5%, 6%. So he said, that's my number. That's a black swan that I've got in my sleeve. The other one is the Fed fights inflation at its current level and it doesn't work. Those are his two black swans. And he said, I don't think the market is prepared for either one.
Let's see. John asks, are we switching to different sectors now? It feels like they're going to defensive sectors now. What's your opinion, Bob?
Well, as yields rise, obviously tech becomes less, I shouldn't say obviously, but in many cases, tech becomes less desirable. And we had the 20-year, for example, go up 11 basis points. We had the 10-year go up 9 basis points from 278 to 287. 5-year rose 5 basis points. The 2s, 10s inversion dropped by 9 basis points, still negative 36 basis points on a settlement basis. So we saw yields rise, and they rose more in the back end of the curve than the front end of the curve. So that means, oddly enough, that the market either thinks the economy is going to be strong, which is the camp that I fall in for this particular yield rise, or that inflation is not going to be tamped down, which I guess is kind of the same thing. Because if the economy is going to stay strong, it's going to be very difficult to tamp down the demand side driven inflation. So tech suffers in that. And you see more of the sort of materials, real estate, industrials will do well during that kind of a thing. So, yeah, I mean, I guess you could say we're switching sectors, but I'm not. I don't know.
Well, again, also, we've had
I was looking at those anyway.
We've had a substantial run up and stuff. I think it's more short term, some profit taking, and there's some minor, very minor rotation, but I wouldn't say it's a major rotation just yet.
Right.
When we start getting the next significant pullback, and one day does not a pullback make. But when we start getting the next main one, that's when we'll start getting some longer term. That's what you got to turn into my weekly sector review. Black swans were killed by the murder hornets. Whatever happened to murder hornets?
They're still there.
What, are they murdering things? I haven't heard much about it.
They're murdering all over the place. I believe the next Stranger Thing is about murder hornets.
Really?
I'm kidding.
The coming food shortage and low crop yields won't help inflation. I thought wheat crop yields were looking pretty good overall.
So
So what else? What else is going on in your world, Bob? What else have you been paying attention to?
Again, I've been fighting the good fight on this peak inflation theme that all of a sudden people think peak inflation. And I posed the question again to Dave Cullum, and he said that people are mistaken. They're mistaking the second derivative, which is the rate of change of inflation. They should be saying the second derivative has peaked as opposed to inflation having peaked. Mike, you put the chart up the other day when I asked you to put up CPI, and we don't need to put it up again. But essentially, I said it today. I said it on the Cow Guy show, which I have on my Twitter. I said it on my Trader Tip, which is also in my Twitter feed. And I just wrote an article for the CME, which they'll put out sometime in the next, I don't know, week, 10 days, talking about how inflation essentially never peaks. And I'm still pounding that drum. So if you look back to March, April, May of 2020, we had 3 consecutive month-over-month headline CPIs that were negative. Okay. And this particular month-over-month wasn't even negative, it was 0. So if you say that this is the first month-over-month number that was not an increase since May of 2020, which was basically the crest of the pandemic, the beginning of the pandemic. Wasn't the crest, but it was the start of the pandemic, and it was the beginning of the lockdowns, right? The economic lockdowns. The first 6 million jobless claims number in the history of the United States was, I think, the week ended April 4th. Okay, so you're talking about March, April, and May, where we had negative month-over-month inflation readings. Prior to that, if you took those out, the last time we had more than 1 month negative, and it was only 2 in a row, was August and September of 2015. That's how long ago it was. So in other words, the CPI index really never peaks. And that's what I've been trying to tell everybody is, peak inflation, things are better, things are better. Yeah, they're better, but they're still really, really high. Prices of everything are really high. And that's if you believe CPI is the true reading of inflation. I don't understand how grocery store prices have gone up between 25 and 40%, but consumer prices are only up 8%. I don't know how that works.
I don't need, and those numbers came. I mean, there are a lot of stories today about that grocery store inflation hitting. And that's big because
it's huge.
It's huge. We all got to eat.
We all got to eat.
At least occasionally. With CPI below target, do you see markets going higher before the next CPI and Fed speak in September?
Well, we've got Jackson Hole before that, John. So Jackson Hole is probably going to be the next big thing. And we've got, it's not like they go into a quiet period before the Jackson Hole Symposium. Neil Kashkari just yesterday said they're not even close to done on inflation. He said that actually, I think it was this morning, not yesterday. So, I don't know that just because we had one CPI, again, one number of 0. So unless you think we're going to get like a cascade of negative month-over-month CPIs, I don't see any way that happens. We already talked about that Bank of America chart that Mike showed. If every single month-over-month CPI were 0%, we would end the year at positive 6.3% on year-over-year inflation. So I did say that I thought CPI to the 200-day moving average on the ES, so the S&P future, and I think that can happen, yeah. We've got a little pullback now to what I consider to be a breakout level on the ES. So we'll see if that holds. I think it's possible, but I don't see it as CPI being below target.
And I personally really don't think with the Fed, really messing up the transitory thing, I don't think they're going to say, one CPI, let's just go to... This is where everybody's still saying, like, eat, pause, pivot, whatever your term is. Even though I agree with you, it's pivot first. I mean, it's pause first. It's not just pivot would be a cut.
Right.
But let's just say, I don't think they're going to go pause. Oh, wait, one print, pause. I still
Agree.
see people talking about that. They're going to pause. I'm like, you think after they screwed it up this bad, they really did. So if they paused and then inflation keeps going or stays elevated, then what? Then, like, why should we even have them around?
Look, real wages, which for those of you that don't know what real wages are, real earnings, it's the increase in earnings minus inflation. Okay. They're minus 2.8 year over year. If you include the amount of hours worked that has been cut, so in other words, hours worked is lower as well. If you were to figure that in, it's minus 3.5%. So that means that people are short approximately 3.5% with what they make versus the growth of prices via inflation. So if you look at it from that perspective, there's only two things that could fix the problem. Then we have to go to my brother's comment because he's my brother. But there's only two things that could fix the problem. One is a slow grind of wages while prices don't rise anymore. And it has to be a slow grind. Otherwise, you get a wage price spiral that continues to drive inflation higher. So that's number one. Or number two, layoffs. And that's, unfortunately, I'll use a restaurant because my brother's in here, but when a business has to choose between the supplies to make its product and employees, it chooses the supplies. Okay, that's what businesses do. They try and get more productivity out of their current employees, right? And they cut labor. That's what they cut. What did he say? I can't read in that small.
In the restaurant industry, we have seen some costs double since the pandemic started.
100% increases, but CPI and PPI are fine, I guess. It's just dumb. So again, like
it's when you believe.
You can ask my brother. I'm sorry, Mike, but you can ask my brother. It's not something that a business owner relishes, but if it's, I can either make my product or let two people go, they let the people go. That's what they have to do. And we're seeing a little bit of that in jobless claims. We're not seeing it in non-farm payrolls yet.
Well, if they don't have the product to sell, it doesn't matter how many people they can employ.
It's pretty obvious.
I mean, if you have a restaurant that has no food, it doesn't matter if you have servers. I mean, sorry, that's where you got to cut first. You got to cut people first before product.
It actually cracks me up, having grown up in a family of small business owners, my brother, my father, myself, you, Mike, right? We all have owned our own businesses. You try to pay the employees even before you pay yourself a lot of the time. You try to. But then at some point when you're choosing between an employee and a product, because both of those things have risen and your business isn't there to support it, you fire the employee. You have to.
Yeah. See, I like your brother already. You got that right, Mike. See? John, you are welcome anytime you want to come on this live stream. You know what? We'll even get you a camera. We'll kick off Bob and we'll bring John on.
Turn on the magic John butt.
Rich says the Fed has officially lost its credibility. I tend to more agree with that, but the Fed doesn't think it's lost its credibility.
Right. I think they have too. And one of the ways to get it back, Rich, honestly, is to continue to push through whatever happens in any other market or anything else and raise rates to fight inflation. They could get a smidge of it back, but I don't know if they will.
John says he is a face for radio.
I am definitely a pretty one. And
okay.
He'll tell you that.
Well, John, it doesn't matter. Look, they let me on live stream, and come on. I mean, some people might put a paper bag over the part of the screen when I'm on, but oh,
you can come on like this.
Yeah. See, people are like, can you just hit the Bob button and make Mike go away? On a serious note, do you guys think metals are heading low, waiting for a boost in the next 3 to 6 months? I don't know your take on metals, Bob. I know what my take is.
Well, I'll tell you my take on industrial metals. As long as the recession narrative fades into the background industrial metals will likely have a bid. And I'm not currently looking at a chart of anything, but I know that copper was up today, and it was largely because of the weak PMI. So I think we had a breakout on copper. I think a pullback buy of copper is a pretty good idea, although that 50 is in the way, so I don't love that. But from a perspective of gold and silver, I would say that gold, the more the inflation narrative rallies to the forefront, then gold would likely get bid. By the way, gold's got a very strong seasonal period starting in September, but right now it's in a weak seasonal period.
And my perspective on gold is I'm watching this pull. I'm watching for a substantial bottom put in. I've said that. I said that. Started talking about that a couple weeks ago. We've had this rally. Now I'm watching as long as but the line in the sand for me is 1733. So as long as we don't get back below that on a closing basis, everything else is a potential pullback trade for me. And on the short term, I'm still watching for a pop to that 200 before getting into some pretty significant resistance area. There's, hey Mike, are we seeing a big cup and handle on? We'll take that. We'll take that after. We don't want to waste Bob's time on Tesla.
Don't waste my time.
Don't waste Bob's time.
I've got to go fix my hair and do my skincare routine.
Now you're going to make me ask. What is your skincare routine?
It's just toner and then moisturizer and a night wrinkle reducing cream at night. That's all.
It's just? What is a toner? The only toner I have is something I put in my printer.
You're way too technical.
No, what is a toner?
Toner shrinks your pores.
Huh?
Toner shrinks your pores.
Okay.
To clean your face more efficiently. Actually, I'm making most of this up.
I disagree. You rattled that off way too quickly. I'm going to ask your brother. John, what's his skincare routine? I need the inside scoop. Oh boy, it's always good to have a little fun with this. Just don't get him started. See, he knows the inside scoop.
He knows.
See, you're not. Oh, I was just kidding about the toner.
The Fed has started QT. Yes.
Yes, the Fed has started QT. It's just not publicly talked about. I mean, just drink water and pickle juice. What's the pickle juice going to do?
I don't know. I've never drank pickle juice. QT has already started. I'm actually just looking up the chart right now to see how much has come off the balance sheet. Oh, don't make me pick the chart. You know which chart I want. Here we go. Total assets, less elimination. So if you go to March 2nd, the Fed balance sheet was 8.904 trillion. And as of July 15th, it's 8.895. So it hasn't fallen much, but it's fallen.
It's fallen. Well,
yeah, it has. QT has started. Yeah, those of you that don't know, that's quantitative tightening, which essentially applies to the Fed purchasing assets or letting assets expire or even selling assets. I don't think they're actively selling assets yet.
No, I haven't. They're letting stuff roll off from what I've.
Yeah, they're letting stuff. I haven't seen any announcement that they're selling it. And John, I mean, you might have seen the market was affected by it. I mean, if you go back to mid-June, the 10-year note was about 3.43%. So the 10-year note yield, but yeah, we're not seeing it now because it's such a small amount versus the other macro factors that are going on, between inflation and Fed actions, et cetera.
All right. Anything else before I just do a quick wrap up with the markets?
Nope. Anything else for me? Any other questions? Otherwise, I am out, and we'll talk to you guys on Tuesday.
Fantastic. I'm not seeing any other questions. Again, thank you for being here. Bob,
Yep.
now I got to. John, thank you for being here for the inside scoop. So please show up more often when Bob is on. And with
More
that,
often than you know.
he
So
just doesn't comment, huh?
he doesn't comment as much as he could.
Hey, John, do you ever tune in when Bob's not here? That's the real question. That's the real question.
I don't know why that scares me.
Why? What scares you?
You and my brother talking without me here.
Always a pleasure. Oh, well, we should. You should tune in when Bob's not on, John. I need some more inside scoop. Hold on. Oh, yes, he does.
Yeah,
Very
he
good.
does.
Again, you know what? I'm going to just propel you up the ladder in the Iacchino family.
Is that a question for me before I hang up?
Amadeus asks, what will it take for the narrative sentiment to flip back to bearish?
Are we talking about stocks?
I assume so, yeah.
Well, look, so here's a funny thing. Again, Dave Collum, who we just did the podcast with, which will be out on Monday, he's a professor of organic chemistry. And I asked him, I said, do you think economics is a science? Because I think it's a philosophy with math. I don't think it's a science. Because you can change definitions in philosophy, but you can't in science, right? I mean, a reaction of H2O is always water. You can't change the definition of it. My point is not his answer. You could watch the podcast for his answer. I heard yesterday we're in a new bull market because it came 20% off the lows. That is incorrect. A new bull market starts when we make new all-time highs. Otherwise, we are still below the old all-time highs. And it, first of all, it doesn't make logical sense to call it a bull market. You know, we're still correcting from the bear. That's number one. Number two, if this is a new bull market, that means during the bear market after the tech bubble, we had 3 bull markets in there. So that means we had 5 bear markets, not just one bear market. Okay? Because we had a over 30% rally and two over 30% rallies and one rally of 45% off the lows. So I don't think I don't think we're bullish right now. I think we're still in a bear market. Now, your question was the narrative or sentiment. I think Jackson Hole is going to be a key to that. Okay? I think that Jackson Hole is going to be a key to that. What's the high of the SPY? I don't really watch it.
Well, a lot of people are saying if you close above the 50% level from the retracement in the S&P, you've never had a bear market in the S&P that's closed above the 50% level.
Okay, all that means is that we're going to achieve a bull market, but we will still be in a bear. You are in a bear market. Once you've closed 20% lower from a high, you are in a bear market until there is a new all-time high. That's it. I'm taking back economics as a science. That is what the difference between a bull and bear market is. But again, very similar to the word recession, who gives a shit? You're either going to make money or you're not going to make money. Like the idea that, so my trade on the podcast this week is buying NASDAQ. I'm buying a pullback on the NASDAQ. But I still think we're in a NASDAQ bear market. Doesn't matter. It's price action and whether you get high probability trades with good reward to risk or not. Bear, bull, doesn't matter.
And from my perspective, you stay in a tactical mode. It doesn't matter because you can still trade on both sides in tactical mode.
Right.
Okay. What was it? I forgot the exact quote today, but I liked it. It was, this is the market that you speculate, you don't accumulate.
I like that.
And I completely agree. That's why I say, there'll be a time, again, where it's more that you can back up your truck and load up with some stuff and just walk away for a period of time. This is not that market yet.
Right.
There'll be a time, again, where, we get great valuations, we get all this stuff out of the way, and, hey, you can put on long-term positions, and you literally don't have to massage them all the time. But this is the one, like, if key targets are hit, I'm out. I'm not going to just walk away in 6 months and say, where'd that apple end up?
Yep.
Because that's when you can give back half your portfolio.
Yep.
So it's speculate, which is, don't accumulate.
Hey, Sterling, you're going to love this podcast. I had no idea that Dave Cullum is like, oh my God, is he libertarian right? Just okay. Sterling, you're going to love it. All right, guys, I got to go. Wait,
All
is that
right.
a question for me? No, that's good.
Okay. No, that was just, we'll see. So, all
All right.
right.
Have a good weekend, everybody. I'll talk to you on Tuesday. Bro, I'll see you this weekend if you're going to Sophia's party. See you later.
All right. Thanks, Bob. Hey, everyone. Let's just get through a quick recap of some stuff. I'm sorry. It's just me back on. The March rally retraced 50%. It's in the S&P here. And that number I think it is correct. That it's never, but again, I'm watching this key rollover zone because of all the stats with the 62.5. And the NASDAQ, if we get a close above the 62.5, then I statistically have to go with the stats that we might not make all-time highs, but we could definitely go higher. But here, yes, you have this red line is the 50%. So on a intraday basis, but not on a closing basis, you have retraced 50%. So what am I watching? I mean, we have the sentiment numbers. Now this can be a fairly reliable topping pattern. This is where I got people, are we crashing? No, we have a 2-bar pullback into the 4-hour rotation zone. We're still above, this is so funny, we're still above the 8th of August highs, so we haven't even pulled back to that level yet. Am I watching for a potential larger topping pattern to form? Yes. Why am I still watching for that? Does that mean I'm turning majorly bearish? No. But we have weekly cycles still at the top. We have way overbought conditions. So just a recap, even if we get a slightly bigger pullback, let me show you from this perspective. We have these highs that are now support. We have these highs that are now support. So if you're looking and you can't look because you may have me on in a car and you're listening, 4182, 4155. We have the lows back from the beginning of August, 4100 essentially. We have the rotation zone. A lot of people key off this 20 or 21. And we have the return to this 37.5% harmonic, which is this red line, 4080. 4020 with the rising 50 and the little peak from 22nd of July and the key close. So you have a lot of pullback stopping points. Yes, could we trigger potentially another cascading move back down theoretically? These are more rare, especially in an August market. Unless we get some really bad news coming out. Earnings season winding down. Again, Jackson Hole at the end of August. No Fed meeting until the 3rd week of September. Am I expecting some kind of pullback? Yes. Am I expecting a massive sell-off? No. If we started to get one, well, we'd start getting bars that would alert us to that. Remember, you're not trying to call every top. And on a pullback, it would even be, look how extended we are. We've had pullback to rotation zone, sideways move, break up from the rotation zone. So all it would be another even pullback to 4150 area would be a pullback to the daily rotation zone again. Could we then form another significant topping pattern? Yes, but it's going to give you time. You rarely get cascading lows like this in this kind of market at this time of the year. Does that mean it can't happen? No, but we'll get warning signs. All right, so overnight, if we break below these lows we bounced off this afternoon, the lows are about I'll go with 4,200. It's 4,202. I'm just watching for this breakout move back from the highs on August 8th, which is the bottom of the 4-hour rotation zone. So 41.85, 41.90 would be my support level. If we pulled back there, then tomorrow I'd watch for a secondary potential reaction. If we rally, everybody should know what I'm going to do. I hope you do. Why am I putting on the harmonics? Because we already had a decent bounce into the 1 hour rotation zone is flattened out. Don't ignore it. But you know where I'll watch going if we bounce overnight. I'm watching first level is about 42.24. Then my major level is 42.31 to 42.38. We start getting a close back above 42.38. Then I'm watching for a retest of the highs, and we could put in a more substantial topping pattern. We come into this area, I'm watching, and we start rolling over. I'm watching for the rollover play, which then we got the short-term rollover play, and then you get the major confirmation if you start breaking to below today's low for a bigger pullback. Where do I really get interested? Well, where do you see the more of a, you see some minor, we're into some minor clear path move. Where do I get interested even more so? We start getting below 41.96 area. Why there? Because remember, this is not something I taught. I'll release this more so in the clear path aspect of the course. When I see a clear path, I like to fine tune it going down one time frame. Go down one time frame, and you still have pretty key support. Just happens to be the 50 exponential, and you have the support ledge. So let's say we got the reaction, we start breaking down, and then you get below this 41.96, 41.97 area again. Then you're into the 1 hour clear path, and I start watching for the bigger pullback with a stop reduction at 41.83. So that's a little lesson of how I start analyzing this kind of thing for a short-term top. And you just see below that 41.83, remember we had that clear path on the 1 hour, and look what you run smack dab into. A major resistance becoming support point with the rising rotation zone, where you could get another secondary reaction back up. So that's why I say I cannot, we can get a pullback move, but do I say, and I'm not trying to call a top with this, because this would be a short-term top because we don't have a long-term topping pattern yet. Theoretically, could we theoretically collapse and market theoretically crash? Yeah, the odds are slim to none. Well, I can't say none. Slim to very, 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 very slim that we crash. NASDAQ, you can do the same exact analysis. Coming up here, by the way, we talked about the Qs. Just jump into that real quick. Because remember, we went over how we derived these areas. By the way, the double in the Qs is now off. This is not a potential double top anymore. So if this key point is broken, what do we target? We target the bottom of the rotation zone and the support ledge. And roughly the 25.5%. Now, you see here we had this cluster, and I showed how we got the resistance line here, and I showed how we got the reverse harmonics. We came up here. We had stop reduction. Then we had a major level, and it reversed off of there. So does that mean that's calling a major top? No, it's calling a minor top for now. And you still have, on the Q, from a Q perspective, you still have a potential gap fill. I don't need to go through everything right now. It's been again, I'm just dealing with a lot of stuff. But you also have, by the way, on the NASDAQ, we have a divergence. Higher high, lower high RSI with weekly cycles still at the top. I'll be more interested if we come back down to the rotation zone, bounce back up, and then the secondary reaction. If we do form a major topping pattern, then we can watch for another breakdown play. If we don't, then we could be targeting that 200. So that's where I'll leave it right now. Oh, Tesla, cup and handle. You asked about a cup and handle. You're talking this huge thing? No. Not because of this. That is not a piece. Some people might trade it if you're a Super Bowl saying, hey, this is just a pullback cup and handle. It's not because of the way that these highs were to these lows and the overall structure. Because of this, that's not a cup and handle. So I forgot who asked that, but that is not a cup and handle. By the way, the double top's still in place. After the stop reduction, even with this move, you've got the gap. You got the gap up today, and then you got the, the rollover play. So nothing's changed, but still the major target. Should you have another breakdown tomorrow, 835? And why is that the major target at the bottom of the rotation zone? Then if you break through there, this would be the minor target, 819. So that's where it sits, but we can take a look at that tomorrow in the morning. Let me catch up now. Are we filling the gap down in the SPYs? Well, we have a nice little reaction at the harmonic. But again, I need to see something more substantial. We don't have the probabilities yet for filling the gaps. The early warning sign would be a break below the low of 416 because we don't even have the gap fill probabilities. The gap fill probabilities are 416.44 on a closing basis. And you are against the rotation zone. So would I be targeting this just yet? No, because you got rotation zone. You got key support here. You got key support here. You could even do a partial gap fill. So that would not be my aggressive target just yet. It's still sort of in... Tell Pelosi I need a pullback tomorrow. Did you see... I forgot who it was, that other stock member. I mean, the other stock member. The other... one of our nefarious leaders who literally a day before she voted on the whole chip bill loaded up on NVIDIA, AMD, and everything. I mean, you literally loaded up and then to cast a vote on the chip bill. Come on. This is just absurd. Connor, thank you for the super chat. Thank you very much. Again, everybody give a big shout out to Connor for supporting the channel with the super chat. Look at the S&P 500 chart on August 11, 2008 was the end of the bear market rally. Also, very eerily how similar the trading has been to the 2008 market at the same time. We can take a quick look at that. We'll go back in the Wayback Machine. Wayback Machine, I remember I was where'd you want? At the end of chart in August. You mean that's through June? We had this little rally, and then you had the cascading over in September, because I remember this really well. I was living in Austin, Texas then. I remember that move really, really well. Really, really well. So, where do I find your course at? I'm still re-recording a bunch of it, so don't even bother with the course. I'm re-releasing. I'm even putting in new material. So you know what? I'm not even pumping my course. I'm just letting people know it is still coming. I'm working on the %B stuff to get that out there first. Probably going to do a displaced moving average little short-term thing to get that out there for people. And then I'm going to wheel out stuff like more of the clear path stuff and more other stuff and build out the whole course and get the double stuff out with some of the revised rules. I agree. I think you're going to get some profit taking because of this massive run-up going, especially with stuff getting out of the way. There we go. Patrick saves the day again. Kathy Manning, Democrat loaded up before vote. I don't even care on somebody's affiliation. It's just, you know what? Democrat, Republican, they're all friggin' I can't say all. A lot of them are just complete. Ugh. with this. You know what? Can we please get rid of this? I call it insider trading by our representatives or passing these bills and they're loading up on stuff, even stuff we don't know about. Come on. Some historical stats seem to will ask. I know it's not tech, but I thought I would share. I'm really going to start paying attention to stuff. Remember, Jackson Hole's around the 25th, and then we go into September, and September is the toppiest month, and September is the worst performing month of the S&P historically. Does that mean it has to repeat that? No, but traditionally, September, people cite the crashes in October. September historically is the worst performing month. So yes, you can start getting some very interesting price action at the end of July. Pre-order on the courses. You guys really want the stuff. What I'll do is once I start rolling some of the stuff out, I'll let people, if they want, pay for chunks and then they get them rolled out. I know. You know what the challenge I keep having is by the time I get done with live streams and everything else I do during the day, like now I need to sit down. I can't even think of recording stuff because I have done it and I go back and watch the recording. I'm like, that is crap. And I end up deleting it because I'm like, I'm not releasing that. And it's probably better than most people do, but I like my stuff to be very high quality. And I hope you guys know I'm not just going to release something because the money's secondary. The money's nice. I'm not going to lie. The money, having additional money come in, especially in inflationary times, is really nice. But I don't do this. I'd rather have something come out very high quality that people can learn from instead of to pump out stuff that you go, yeah, it's good, but you know what? I can't even see what he's talking about. So that's where I sit. Any opinion on the semiconductor space as a whole? They have led this rally, but recent guidance, I think, again, it's rolling over. I'm watching for the next big rollover in the SMH. What do we have now? Again, we still didn't complete the full double. And what you have now there's no guarantee that this has to trigger. But we do have a potential double top. And I'm watching longer term. I've said this before. Longer term, I'm watching for us to now the 200 keeps climbing and we have the 62.5 level right there. I'm watching for us to at least come back down here. Longer term. Again, that could be 6 months from now. But I'm watching for this. And if we get a close below the 62.5, I'm watching for some of these COVID lows potentially. There'll be stuff some stuff will just be individual modules. Some stuff will be the course. I don't know if you guys want me to release it as just individual modules or as there'll be, if I do release it as a course, there'll be a beginner section that is stuff that you need as a foundation, then more intermediate and more advanced. Or if you want it all as separate modules. But the problem I have with that is people try to pick and choose, and then I'll reference something in another module. Like if you don't understand all the nuances with a clear path, and I say, only execute this trade into a clear path, and you don't understand all the nuances, then it's not really going to help you if you just bought a one module that references something from another. You listen to me even on this. That's why I like to assemble all the concepts together. So no, I don't. It's not going to be one of these astronomically priced things. It'll cost money because it's going to tell of a lot of my time. But you know what? I'm not going to be one of these people that releases garbage for $5,000 and you know what? Oh, buy this and you know what? I'm gonna charge you outrageous sums of money. I'm still waiting for the new one to come in. And then I have to set that up for streaming and everything else. So, and then longer term, I'm going to hopefully, once I free up some time, I'm going to keep trying to pump out this course. And then I want to do some stuff for people who are interested with some more Python and system development in some stuff like Python. if anybody's interested in that. And Python's fairly easy to learn. So that's my next major thing that I want to really focus on next year. Especially once we get through the finish with the bear market, so people can work on some stuff, people can start doing some other interesting things, and they can develop some things for themselves. So again, if you're watching this on replay, let me know what you think about some of that. I just want to, and by the way, again, we're closing in on that 5,000K subscribers. If you haven't already subscribed, please do. Be one of those people who pushes us to 5K. George, before you go, is this lower CPI and PPI making the yield curve rise? It's the change in I think it's more the change in how people perceive what the Fed's going to do. And remember, that's when I start getting really edgy. As we get towards zero, I talked about that on the last Futures Edge podcast. As we get towards that zero level, do your own research. You can call up the yield curve. If you're on TradingView, you punch in US 10Y minus US02Y. So you type this in if you want to follow it yourself. And that gives you this. And now, as we start, interesting enough, on the daily basis, and these numbers are a little off because it's actually the TVCs, but we technically have a double bottom for them, so this would be interesting. I should actually just plot this out. I'm just fascinated. But once we really start getting back above about negative 17 basis points, I'm going to really start watching for a potential market unravel. Keep that in mind. And look where your declining weekly rotation zone is. So I could see it coming up here, or reaction somewhere up here, a little pullback, and then you start accelerating back in that weekly rotation zone. I'm going to be really focused on downside. What's Python? It is a fairly simple programming language, and there's lots of good libraries out there for development and testing of stuff you can do for some easy systematic testing in the markets. You can do some fascinating stuff. You can even plot like option curves in it. And once you have it, you can find a lot of scripts out there and everything else, or a lot of code written in Python. I shouldn't call them scripts. But you start really playing with stuff. It's fun. And it's not like I'm not talking you have to learn something like C or C Sharp, or JavaScript. This is stuff, and there's a lot of quants know Python. And if you can do stuff in Excel, you can transition to Python pretty easy. So if you've done some pretty heavy duty stuff in Excel, which I don't know a great trader who doesn't know how to at least manipulate a fair amount of stuff in Excel, then you should be able to pick up at least the essentials with Python and be able to find code out there and even modify it yourself to do some stuff you want. And then you can start doing some tests. You can start doing some really fascinating stuff, and you can start doing some more quant stuff. You have a great night too. Thank you, Daniel. Thank you for the super chat again. Daniel with the super chat, and we had Connor and Daniel. Big shout out to them. Is that a good thing for the market when the 10-year goes back to zero? Well, I'm talking the spread. I'm talking the 10-2s. No, it's not. Do some research. You can overlay stuff also. Like if you hit this and you type in the SPX and you start overlaying it with a longer term like a monthly, Let me get it on the screen here. As you start getting the moves back to zero, you start historically, that's when you start getting the bigger sell-offs. Okay? You start getting the move back to zero, you start getting the more accelerations. And once you get, especially above 1.5 to 2, you start bottoming, getting into a bottom area. All right, I'm going to call it a day. George, you should start following the 10-2 chart. There's why we don't put a lot of garbage stuff in this stream. If I put it in the stream, you should probably pay attention to it. I'm not talking every stock, like if somebody shouts out a go-go stock, but I'm talking like when I put up the like the high yield corporate bond ETF, because you can chart this out. All right, when this really starts rolling over again, start watching for a significant sell-off again. Okay, and you can chart stuff like this. Again, double bottom in this, and we've got that rallied, and we got the market rallied. Because this is, and bond markets and credit markets generally lead the equity markets. You're welcome, Amadeus. Why don't you make an AI and I'll buy the program? Because what I do with what I teach here is way too hard to put into algorithms, and there are different algorithms that I have that are, you run them independently. Again, you can have algo trading systems, but I like to have what I like to do historically is have a bunch of different non-correlated algos that actually give you a pretty smooth return curve that you can just set up with APIs like the interactive brokers or any other thing that has API hooks in it, and that they just execute, and you can let those execute. Then independently, I like to do some more, I'd say the stuff I teach now is more proprietary stuff because you got to put too many components together. You're welcome, Connor. You're welcome, John. Your chart with the 10-2 and SPY is really good, and that's something to keep an eye on. I'm wrapping it up for today. Hope some people learned some things with that. I will talk to everyone tomorrow morning, and have a wonderful evening. Bye for now.